All right, let's talk about something you've probably heard thrown around this time of year, the Santa Claus Rally. You know, the idea that stocks just magically seem to go up right at the end of December. But is it a real thing, or is it just a nice story we tell ourselves, kind of like a Wall Street fairy tale? Well, we're going to dig into the data and find out. So, what's the deal? Is this whole Santa Claus Rally thing just a fluke with a fun name? Or is there actually something to it? A real pattern backed by cold, hard numbers the traders have been seeing for years? Well, I'm just going to give you the answer right up front. According to decades of data, it's surprisingly real. Yeah, no kidding. This isn't just a myth. It turns out to be a pretty consistent trend. So let's dive into the proof. Okay, to kick things off, we're going to start with the big one, right? The S&P 500. We're going to look at a couple of super simple strategies that have been tested going way, way back, thanks to some great work from Quantified Strategies. Let's see what the numbers say. So, strategy number one couldn't be simpler. The rules are easy. You buy the S&P 500 1 week before Christmas, and you sell it on the very last trading day of the year. That's it. We're talking about a super short time in the market, going all the way back to 1960. So how did it do? Okay, so a 0.7% average gain might not sound like it'll make you rich overnight, but hang on. Remember, you're only in the market for about a week. But here's the really interesting number, the win ratio, 66%. That means this strategy made money 2 out of every 3 years since 1960. That's not bad at all for such a simple rule. All right, so that was one test. But what if we hold on for a little bit longer? Let's see if this pattern is a one-trick pony. For this second strategy, the rules are a little different. You buy on the Friday before options expiration week in December, and then you sell on the third trading day of the new year. And wow, the results here are even better. This really shows you how solid this pattern seems to be. The average gain more than doubles to 1.6%. The win ratio jumps up to 72%. And that profit factor, it gets a huge boost. Let's just stop and talk about this profit factor of 4.0 for a second, because this is pretty amazing. What does that actually mean? It's simple. For every single dollar this strategy lost on its bad years, it made $4 on its good years. Think about that. Over more than 60 years. That's a really powerful edge, historically speaking. Okay, so it's pretty clear the Santa Claus Rally shows up in a US market data. But is this just an American thing? You know, something unique to Wall Street? Or does this holiday cheer go global? Let's find out. First stop on our world tour, Europe. We're going to check out 2 of the heavy hitters over there. The German DAX, which is like Germany's Dow Jones, and the Stoxx 50, which gives us a look at the whole Eurozone. And get this, the numbers in Europe are frankly incredible. Both indexes had a win ratio of 81%. That means they were profitable more than 4 out of every 5 years. And just look at those profit factors. A 13 for the DAX and a 9 for the Stoxx 50. It's not just happening in Europe. You could argue it's even stronger over there. You know, I love this because this is a direct quote from the source we're looking at. The researchers themselves were so blown away by the German DAX results that they literally put an exclamation point in parentheses. When the data nerds get that excited, you know you're looking at something pretty wild. All right, so the pattern is solid in the big, developed markets of the US and Europe. But what about the more unpredictable, more volatile emerging markets? Does the holiday magic work there too? Let's take a look at the data going back to 1990. And yep, the pattern holds up. A 73% win ratio, a really solid profit factor of 6, and check out that average gain, 2.7%. This pretty much confirms it. This isn't some quirk of Western markets. It really does seem to be a global thing. Okay, for our last piece of evidence, let's zoom in on one specific and really important emerging market, India. We're going to look at its main index, the Nifty 50. Now, the data here is a little more recent, starting in 2008. And even with a shorter history to look at, the pattern is crystal clear. A win ratio of 71% and a profit factor of 6. So yeah, from New York to Frankfurt to Mumbai, it seems like the end of the year has historically been a pretty sweet spot for the stock market. So the data is pretty overwhelming, right? The pattern is there, which leads to the million-dollar question. Why? Why on earth does this happen so consistently in so many different places over so many years? Let's get into some of the theories. Well, there's no one single magic answer, but it's broadly a mix of a few things. For one, you've got big money, mutual funds and the like, shuffling their portfolios around for tax reasons and year-end reports. On top of that, it's usually a pretty quiet time for big, scary economic news, so there's less anxiety in the market. This all happens to overlap with something called the turn of the month effect, which is already a pretty good time for stocks. And then there's just, the vibe. Holiday optimism, people are feeling good, and a lot of the big-time traders are on vacation, which means maybe there's just less selling going on. So we've looked at all this data from all over the world, going back decades. What's the bottom line? What should we take away from all this? First things first, let's just nail down a clear definition. The Santa Claus Rally isn't just a cute name. It is the real, documented, and data-backed tendency for stocks to do much better in that little window between the last few days of December and the first few days of January. And really, the main thing to remember is that this thing is real. Now, is it a 100% guarantee every single year? Of course not. Nothing in the market is. But it is a remarkably consistent historical trend. And maybe the coolest part is that this isn't just some Wall Street quirk. It's a pattern we see again and again in markets across the globe. And that kind of leaves us with a really interesting question, doesn't it? If there's such a strong, predictable pattern just sitting there on the calendar around the holidays, it really makes you wonder what other hidden patterns might be out there, just waiting to be found in the market's data.